In the previous video, I explained what stock ownership is in a company. Now we're going to get practical, because the first thing most people do after understanding stocks, in theory, is open an app and look at prices. And that's where the first mistakes usually begin. When you look at a stock quote, your eyes are immediately drawn to one number: the price. It can be $30, $100, $1,000. It feels intuitive to think that lower priced stock is cheaper and a higher priced stock is obviously more expensive. But that intuition is wrong. Basically, everything we have learned in life does not apply when looking at prices of stocks. Now, let's talk about price versus market capitalization, which I will refer to as market cap. The price of a stock by itself tells you almost nothing. What actually matters is the size of the company behind that price. That is what market cap measures. Market cap is simply the stock price multiplied by the number of shares. In other words, it's the total value the market is assigning to the company. A $10 stock can represent a massive business if there are billions of shares. A $1,000 stock can represent a much smaller company if there are only a few shares. So, when you buy a stock, you're not buying a number. You're buying a slice of a company. Price tells you the size of this slice, but market cap tells you the size of the whole pie. Imagine you are in a shop and want to buy some orange juice, or it can be any type of juice. One bottle costs $5, another costs $7. If you only look at the price, the $7 bottle is obviously more expensive. But when you look closer, the $5 bottle is 1 liter, or about 34 ounces. The $7 bottle is 5 liters, which is about 1.5 gallons. Now you realize the price alone didn't tell you much. What mattered was how much juice you were getting in total. Stocks work in the same way. The price of shares tells you the cost of one unit, one share. Market cap tells you the size of the entire company behind it. Let's look at another example. Costco's share price is around $1,000, much higher than Nvidia's 185 as at recording this. If price told the full story, you would expect Costco to be the large business. But when you look at the market cap, Nvidia is far larger. The difference isn't the business quality, it is the number of shares. As you can see, Costco has hundreds of millions of shares. Nvidia has billions of shares. If we multiply the number of shares by the share price, we get the market cap value. And so, without knowing the true size of the business, the price of a single share is meaningless. Another number beginners tend to ignore is the bid and ask price. On your screen you will often see a single current price. But in reality there are always two prices underneath it. The bid is what someone is willing to pay, whereas the ask price is what somebody is willing to sell for. That difference between them is called the spread. And that spread is not noise, it is real, it is a built-in cost of trading. In very liquid stocks, the spread is tiny. In thinly traded stocks, it can be surprisingly large. This matters because the price you see is not always the price you get, but in the end, liquidity affects how easily you can enter and exit without friction. This brings us on to volume. Volume tells you how many shares are being traded. A stock that trades millions of shares a day is very different from one that trades only a few thousand. Because high volume generally means easier entry and easier exit. It also means less distortion from individual trades. Low volume means wider spreads, higher friction, and more sensitivity to individual buyers and sellers. This is not about opportunity, it is about risk. Liquidity is a practical constraint that many beginners discover only when it is too late. Now let's talk about the most emotionally difficult number on the screen. And that is the red one. When a stock price is down, your app shows a loss. It feels immediate. It feels personal. It's horrific. But it's important to understand the difference between realized and unrealized results. An unrealized loss is a price movement. A realized loss happens only when you sell. Until you sell, what you are seeing is a change in how the market is valuing the company at that moment. That doesn't mean the business has failed, and it doesn't mean you have made a mistake. It means that the price has changed. I also want to mention that prices are not scoreboards, because this is where many people get trapped. They treat short-term price movements as feedback on even their intelligence. Up feels like success, down feels like failure. But stock prices are not scoreboards. They are estimates, constantly changing, often emotional and sometimes completely wrong. Understanding that distinction is not philosophy. Understanding why the price has changed is also not a philosophy. If the business has not changed, then the price movement, let's say it goes down, it doesn't change the business. So it is a momentary change of market valuation. This is important to understand because it is practical survival. So, when you look at a stock quote, don't just look at the price. Ask yourself, what is the size of the business? How liquid is the stock? How easily can I enter or exit? Is this movement a final outcome or just a fluctuation? In the cases where your stocks have gone down, for example. Stocks are simple instruments, but the screens we look at can make them feel deceptive. Learning how to read what you are actually seeing is one of the most important practical skills in investing. So, this lesson wasn't about picking stocks, it wasn't about predicting prices, it was about learning how to interpret the information in front of you correctly. Before you can make good decisions, you need to read the environment clearly. That is what this practical view of stocks was about.